Thank you. Thank you for coming this morning. So I kind of do this almost every day in terms of producing material like this for my institutional clients. And I bring it fast and I bring it hard and I bring a lot of material. So there's a lot in here. I've had to cut it back like 9 times because Mike keeps telling me I can't go over. So I could talk for 2 hours about this stuff and only cover the first topic. So I'm going to hit you hard and fast. There's going to be a PDF available with the text, so you don't have to feel like you have to read every word, and actually with more text that I had to take out here. We're going to start. It is about investing in the age of polarization. So the first thing you ask is, what is polarization? Well, you know what polarization is. You feel it, you see it, it's everywhere, in everything, in everybody. Politics, the weather, certainly human behavior, random violence versus acts of charity. You see it in the environment, of course, more and more basically unstable. And certainly in the markets. When I was here in 2020, one of the things that I said was the one thing you can be certain about and take away from this conference 3 years ago was that volatility will expand, and that expansion is a new trend, which will extend time-wise and in terms of the intensity of the volatility. And that certainly has happened. But there are actually scientific reasons, and I don't want to get too deep into the science. I did a lot of that in 2020. But the bottom line is, this is a physical dynamic happening here on planet Earth. The solar system has two different orbits, one within our own spiral arm, and then with the spiral arm around this black hole at the center of the Milky Way galaxy. And where we are now, right now, is a highly energetic, electrically charged area of the Milky Way. What you have here is these positively charged ions are bombarding the planet. Basically, it's light plasma that is coming from a variety of sources within the Milky Way that are now in close proximity to us. You got supernova 400 light years away. You have all kinds of star clusters, exoplanets. You have binary star system, not too far away either, which is pretty rare. And you have quasars and pulsars. It's an electrically charged area. And in this case, you also have 25,800-year cycles that once in every 30,000 years, you have an alignment of star systems that is polarizing, that pulls at the gravitational pull. So not only be highly charged, you remember my speech in 2020 with the M&Ms in the mason jar. So this is a volatile, electrically charged geomagnetic situation here on planet Earth, and it affects the markets. It's here to stay, and you're going to have to deal with it in terms of the intensity of what's coming next for central banks, for money printing, and for the markets, and for the survival of the value of your paper wealth and income. That's what this is really all about. So we start with Niagara Falls. Bank of Canada, just recently, I think it was last week, basically took their foot off the brake, said we are going to pause at the current level while we impact the dynamic that we've just put in place, which is a really massive degree, almost draconian degree of monetary tightening. 425 basis points up, 8 meetings in a row over a 10-month period, they have raised interest rates. It's a 1,700% increase in interest rates. Now, we talked about this years ago, that when rates got so low, the compression would cause the volatility to expand. And you kind of get normal moves in markets that now seem really dramatic. And that's going to be something that continues, especially on the back end of this. You can kind of see, one of the things that I'm all about here is, this is a 40-year downtrend in inflation and interest rates. Perpetually lower lows, lower highs, very well defined, especially in the bond market. You look at a 30-year bond chart, it's just a channel down. The problem is we got to zero. We know the European experiment failed miserably in terms of taking interest rates into negative territory. It just sucked money right out of the economy. It also sent a psychological message to people that the central bank is so worried you're going to have no growth that we recommend you pay us to hold your money for 30 years. Perhaps the most insane idea they've ever hatched. And they've been pretty creative since 1971 in keeping this thing perpetuating. But the problem here is now you've established a low. And no matter what we do here, if the Bank of Canada is going to say pause, the Fed's going to eventually say pause. They'll probably be the last one. We know they missed the boat in terms of tightening. They're going to kind of miss the timeline here in terms of maybe taking their foot off the gas, off the brake. But the problem is, if we start to reflate from here, stock markets near record highs, you've seen the moves in copper and gold. I mean, people say, why isn't gold performing? It's performed great. It held up in a 20% rally in the dollar. What if we reflate from here? And I think the Fed is petrified about that, because what that means is higher highs and higher lows and a new uptrend in inflation and interest rates. Problem is, it's unavoidable in my mind. This is what's going to happen. When you look at inflation drop from 8.1 to 6.3 in Canada, I mean, it's almost a 200 basis point decline. The problem is now that inflation has fallen below the level that the Bank of Canada started raising rates. In that sense, from a 25 basis point rate, when the inflation's 6, 7, you had a real policy rate of almost -5.5. One of the deepest, most stimulative policy rates on a real basis we've ever seen in Canada. Now, you're talking about -200 basis points. Now, -200 basis points, that might be something you'd see in a recession. You might even get -300 basis points as to be stimulative monetary policy during a recession, which Canada is a little behind the US. I'd say the US is already in recession. We'll get to that in a minute. But when you look at this dynamic, I mean, when you get to a level where you're kind of here, if you come down in inflation any further, you get to a point where maybe inflation drops below the central bank's rate of 4.5%. And all of a sudden, the central bank is restrictive during a recession. And that's going to only permeate and perpetuate that recession, make it worse. CPI is one of the sticky points. And when I talk about food inflation, I really focus on places like Eastern Europe or Asia or South America, emerging market countries, where the income per month, the per capita income is so low, and inflation in food is as high as 30 to 35% in a lot of places. Think about the choking how choked out consumers are in some of these places. This is a global dynamic that is much worse in a lot of other places where they can least afford inflation, especially in food. So the good news is that the headline rate usually leads the decline and food follows. And we're in that situation right now. The blue is the food, the black is the headline rate. You can see the headline rate's already started declining, and you get a usual lag time. This should bring food prices down. So this will be encouraging to central banks as they see inflation come down. And you see it already in terms of energy. Gasoline from 13% year over year in a single month goes to 3. Transportation, big part of that's gasoline. This is Canadian numbers from 8.5 to 6 in the most recent month. And set to get even lower. Why? It's called the base effect. You have a situation here where gasoline in Canadian dollars was trading 3.25. Now it's trading 3.25 last January. February, March, April, you can see it goes up to $4.50, goes up to $5 by May. So if we don't rally significantly in energy prices here, which is always a possibility, you're going to see a dramatic negative influence from the base effect, the year-over-year mathematics that go into inflation that will bring inflation down hard and fast in the coming months, to the degree that probably all of a sudden Bank of Canada turns around and wow, we're restrictive, and we have declining employment, we have a situation in the housing market, so this sets up a really bad economic situation more towards the second half of the year. I think the first move is they pause, you get a rally and everything. Could even be a melt-up situation in stocks, and the economic realities hit in the second half of the year. Also, you have QT, and it's almost like they're doing all this into what is kind of, in Canada, not yet there, but turning into what's going to be a recession. And you can see the degree to which they have pared their balance sheet by 25% in the last year. They've liquidated, quote unquote, $140 billion worth of bonds. In other words, they're not buying that much anymore. You're removing the largest buyer of bonds in the world at a time when debt is exploding and the supply of bonds is set to increase and is increasing dramatically, particularly in the US. So the last paragraph of the central bank's monetary statement said, we are trying to balance the risks. Jerome Powell said the same thing. It's like you a little too tight, too far, too long, we bring the economy down to its knees. We don't stay if we take our foot off the brake too early, or we talk about easing too quickly, and you reflate from levels that are kind of unacceptable to central banks. So it's almost like they're trying to do the impossible. It's almost like they're trying to be Nick Wallenda and walk across Niagara Falls on the tightrope. You have the balance bar, too far hawkish, boom, you're off, you're dead. Too far dovish, you're off, you're dead. It's almost, it's an amazing feat how this guy even did this, is mind-blowing. And you kind of see the setup for his walk. The problem here is, right, you're kind of getting a 3-year to get across this little treacherous dynamic here. The problem for central banks is they got to turn around and walk the other way. There's no getting off this high wire for central banks. At some point, and I think the Fed made the first mistake earlier in the year when they kept saying transitory, transitory, transitory. I think everyone with half a brain knew it wasn't going to be transitory, except the Fed. Why does this all matter? I love this chart, courtesy of Ed Yardini. Okay, he's one of the best in our industry in terms of the research side. And I've done this similar chart myself. It maps the QE by the G3 central banks in the blue line against the S&P 500. It's 100% correlated. You're in a situation without perpetual printing of money, you have a lot of problems, particularly in the markets. And if the stock markets go, that's your last bastion of wealth creation, your last bastion of protection, so to speak. And that would really bring the hammer down in terms of the economy. Talk about a consumer that's choking. You bring the stock market down, that's kind of like the final straw. Godot has left the building. Well, maybe some of you remember the famous play by Samuel Beckett, Waiting for Godot. All right? It's a couple of guys waiting for their buddies, sitting on the side of the road, and the entire play is just the two of them talking. Should we stay? He might show up. Maybe we should leave. He's not coming. Well, he might leave. The second we leave, he's going to come. This was like the Fed waiting for inflation for the last 15 years, right, since 2008. Godot never showed up. I wrote a piece in 2021, Waiting for Godot, the alternative ending, where Godot shows up, and he won't leave. And if Godot's inflation. Well, Godot showed up, but it looks like there's rumors that Godot has left the building. Well, in the US, it kind of looks that way. Inflation's gone from 9.1 to 6.5. Not only that, you look at a decline of 0.1%, the most recent CPI in the US. Then look at the last 5 months. You know, even 4.4, okay, when you had that in September and October. Annualized, that's 4.8. That's exactly where the Fed funds is right now. So you could make a case that based on the last 6 months of monthly inflation data, that the Fed is actually neutral right now. And they don't have to go any further because inflation we know is going to come down here too. And all of a sudden the Fed's going to be tight into what is clearly a recession in the US. So not only that, but the average monthly gain over the last 6 months gives you an inflation rate that's less than 2% annualized. It's below the Fed's target over the last 6 months. Think about that. Not only that, this decline in December was historic because you don't really get many of them. In the history of this index since 1971, 43 months of down inflation for the month, all right? This is the 24th deepest decline in the history of the number, and it's the 8th deepest in the last decade. So when the Fed's talking about this inflation, here's polarization for you. You have record highs in the year-over-year rate, and now you have historic deflation in the short-term numbers. It's the same thing. Everything is polarized, even the economic data. This is why people think there's no recession, and you have an equal amount of people think it's a recession, and it's kind of like, you know, there's no middle ground in anything anymore, as you know. Interesting to note the city numbers, because where more people live, the high inflation's higher, it's more of a choke to the economy, and the vice versa. City inflation led the way higher during the rise in inflation, clearly was a leading indicator, was a great tell, and it's giving you the opposite input here. Look at the monthly declines. Look at some of the lagging numbers for like San Francisco, one of the highest inflation places in the US, maybe a year and a half ago, now below 5 and down, you know, down for the month. You know, you can see the numbers. I mean, this is a skew to the downside for sure. Now, a lot of numbers and little data points on here, but it's important just to note, 42 special aggregate indexes that the BLS prints for CPI in the US. 21 declined for the month. The special aggregate indexes are really the key to me. These really gives you a picture of where are the holes in the argument you might be making. 15 on inflation. But worse than that was the averages. The average monthly decline in the 21 that declined was over 2% for the month. That's 24% annualized. Versus the average increase was less than 1/3%. The skew here is dramatic towards the disinflation, deflation, and you have the same dynamic here in terms of energy and the base effect with gasoline in the US, which went to $4 in May. We're at $2.40 now. You're talking about a significant percentage decline if you don't rally. Now, gasoline could go back to $4 by May. It absolutely could. But as it stands now, the situation is set up for a dramatic decline in inflation around the world based on the base effect. Central banks react, they take their foot off the brake, and guess what? The problem with a lot of this is a lot of things, not necessarily gasoline, but a lot of the things that are higher in price, food especially, could come down, could get negative year over year. They're not going back to pre-pandemic levels. This isn't transit, there's nothing transitory about it. The inflation is permanent, and it will stick with us even if we have a period of disinflation or deflation. You're not going to go back down to price levels that we saw before the pandemic. The horror. Apocalypse Now. Maybe some of you don't remember the movie, maybe some of you do. The character in that movie talked about like he just had enough of all of what's going on. It's kind of like what I feel now. It's like, if you remember the movie Network, the guy's like, I just can't take it anymore. You know, I mean, it's like people have lost their freaking minds, it seems, right? Well, this guy in the movie, Colonel Kurtz, he leads his own personal army, and he goes kind of off the chain, right? And he just goes around and starts killing people. And it was just really interesting in the sense of that's kind of where the economy is. It's like, oh my God, the horror, the horror. When you look at, are we in a recession, or are we going to be in a recession, or can we have a soft landing? I don't know. What I can tell you is when these three things happen at the same time, 100% of the times it's been a recession within 12 to 18 months. Food at home, year over year above 6, it's 11.5. It peaked at 13, it's still double digits. US Treasury curve inverts, it's most inverted since the 1980s. US dollar appreciates by 20% in a 12-month period. It just did that ending May. And in fact, relative to gold, it was up 30%. And when you get those two things together alone, that's a dynamic that is really interesting in terms of emerging markets, for one, and we're seeing that effect too. But these three things together, recession 100% of the time. It's glaringly obvious the acceleration and the angle of ascent here is something we've never seen, not even in the 70s. And again, this is my point here. Even if you get some deflation, year-over-year deflation, this number is not coming back to 240, 250. It's just not. This index is not ever going to be back there. So in that case, food will continue to cost more going forward. The year-over-year rate, you can see here, double digits, highest since 1979. But the year-over-year rate doesn't capture how much money this represents. Everyone's earning more, there's more in the stock market, the Fed's printing more, there's more money everywhere, and it costs you more money, actual dollars and cents to buy food. The index itself, the increase over the last 12 months at that peak is more than twice anything we've ever seen in the modern monetary era. Basically, since 1971 when the US went off the gold standard. I mean, this is mind-numbing in the sense of how much money this actually means. People have to spend more on food to eat. And you see this in terms of the retail sales numbers that we'll get to in a second. Most inverted curve since the 80s. Dollar up by 20% in a 12-month period. You can see the other times that's happened. These things individually may or may not, be a tell for a recession. Together, 100% of the time. Wow, okay, lost all that. So this is the US savings rate. You hear on TV about the giant pool of savings that the consumer's sitting on. The consumer balance sheet is very healthy here. And you hear from the credit card companies, and it just blows my mind, the financial media. It's like, oh yeah, American Express and Visa and Capital One and all these people tell us that the credit card demand is very strong from consumers. And it is, because it's credit, all right? Why? Because savings has disappeared. All right, you've gone from 6 trillion plus in savings. It's a monthly annualized number that we get from the I think it's the Commerce Department, one of those bureaus. But in the sense of the actual dollars in savings, okay, 6 trillion here, and that was the savings rate. So you went from a savings rate of over 30% all the way down to a savings rate of 3.4 currently, all right, as low as it was since 2005. When you go to the actual dollars, right, $6 trillion, now 600 billion. 90% wasted, all right, spent, frankly. In the case of wages, this is the year over year of average weekly wages. Oh, and by the way, hold on. This is the wrong presentation, isn't it? Wait a minute, let me see here. No, okay, there we go. We get to it. I guess we must have went over this. But anyway, so year over year, you've gone from high levels of wage gains to 3%. You're back to levels that are below pre-pandemic levels in wage gains. The problem is inflation isn't there, and the problem is real wage gains are negative still. When you get a paycheck, by the time you get to the bank to cash that paycheck, it is going to buy you less stuff. This is the whole dynamic around where we're going with this. It is the debasement of the value and the purchasing power of your paper money. So back to savings, all right? We know that government transfers, which is basically handouts, social programs of all kinds, hit $6 trillion during the pandemic. You can see that this is a straight one-way street to the upside. But what's really interesting here is that at the peak of savings at $6 trillion, the peak of transfers of government handouts was also $6 trillion. Coincidence? No, of course not. But what's happened since is highly problematic. You have the transfers are still $4 trillion, and the savings is $600 billion. That's a giant hole that's been blown open in the consumer. and it shows up in retail sales. You really see it here. You have back-to-back months of over 1% decline. You have 4 out of the last 6 months with declines in retail sales. I can tell you that retail sales do go up and down in a month, but these numbers are really poor. And again, a lot of numbers here, but over the last 2 months, the monthly numbers, 34 down, 7 higher out of 2 months. Not only that, you have back-to-back declines in sales at eating and drinking establishments. That never happens when you have gasoline sales down. There is a direct correlation between the amount of money consumers have to spend to buy gasoline, and when they have to spend less on gasoline, there's a 3-to-2 correlation with eating and drinking, going out, and online shopping. That has disappeared, which to me tells me the consumer cocoon has started and is already hardening, and that's a big deal to me. Not only that, but look where we are with the $8 trillion the U.S. printed, all right, that went to consumers. It's spent, the savings are spent, we boosted retail sales, and guess what? We are so far out over our skis here, it's kind of insane. I mean, you look at the trend line here that goes back to 1990. We decimated that in 2007 and 8, all right? Then we created a new trend, all right? We crushed that in the pandemic, and then you print $8 trillion, and now you're at new highs beyond any trend that we've ever seen in this data series. So just to kind of come back to a trend that might be sustainable will take tens of billions of dollars of declines in retail sales. And it's just one of these things where it's just, to me, looks technically unsustainable. And frankly, when you look at all the background data, it seems fundamentally unsustainable. Let's talk housing. The rise in mortgage rates in blue against mortgages. All right, this was I believe it's the mortgage purchase index, yes. I mean, the declines in the mortgage purchase index, you're talking 45% year over year. The declines in the refi applications for refi loans in the US, down over 90% at the low year over year. So the Fed has successfully pretty much crushed the housing market. The mortgage market has crashed and no one's talking about it. It's kind of like, oh, it'll come back, whatever. The complacency is mind-blowing. But it's in every data point here. And this is why I love the charts. You can hear the housing is down. You can hear it's this annualized number. When you see a chart like this, and the next few I'm going to show you, it really wakes you up. I mean, it's kind of like, well, wow, we're breaking the uptrend that goes back to the 2009 low. It's a 15-year uptrend, and we're down. Not only this, in terms of housing starts, this also gives us a lead on the future, which really suggests housing prices ultimately will go a lot higher because we don't have enough supply to begin with. Now we're not building new supply because demand is down, and that's a bad combination going forward. But in the near term, it's a bad combination for the housing market itself. Starts breaking the trend line. Permits wasting the trend line to the upside. I mean, that's almost an historic fall if you didn't have 2007 and 8 up there against it. Existing home sales. I mean, look at this, from 6.49 million annualized to 4. Over a 30% decline since January of last year. I mean, it's recession. This is recession numbers. How do you look at this and not say the economy is soft landing, no problem. There's your chart going back. You're talking about taking out the 50-year uptrend in existing home sales. I mean, this gives you a little more of a tangible view to me. This becomes more guttural when you see charts like this, and that's why I love to use these slides. Prices have gone down, seasonal, very seasonal on the new existing home sales average price, all right? Always peaks in June, every year, and it peaked in June this year. But it's down $50,000 in the last 6 months. Think about that just over a year's period. I mean, this is borderline turning into kind of a crash. Now, I don't think prices will necessarily come all the way down because you're still going to face a supply shortage in the future. But in the meantime, it's just ugly. And frankly, existing home sales against the stock market, that doesn't bode well for the stock market. It just doesn't. And even the times when the overlay is not like one-on-one on top of each other, the directional positive correlation is very high. This is a very correlated dynamic right here, and it is very, very negative at this point. And again, people don't want to talk about housing. You don't hear much about it in the financial news. Manufacturing sector in the U.S., Empire State. This is a recession-like number. You have numbers we saw in 2009, in the pandemic. That's the only other times. And now you have this organically. We don't have a pandemic right now, except maybe people's brain cells. But, you look at the Small Business Confidence Index. Again, the last time we saw it was 1980. I remember 1980. I'm old and decrepit, man. You can see that I can remember 1980. It was vicious, 2007 and now. 1980, 2007, and now. No, we're not in a recession. Soft landing's coming. And I have a bridge in Brooklyn I'd like to sell you. Now, this really gets interesting. You talk about recession. The ISM is a great treasure trove of information, the Institute for Supply Management in the US. All right, the manufacturing sector peaked, 50 is the boom bust line, below 50 is contraction. You're contracting in the manufacturing sector, but worse, you're contracting in the service sector now. And this is peaked later, has come off harder short term, and is the bulk of the economy, all right? Plunging into negative territory. Really bad numbers on orders. I didn't keep the orders. But this is Colonel Kurtz, the horror. This is the economic forecast for the second half of 2023. Now, the Fed. A year ago, a lot of things here, but what you want to look at is the red number one. For this year that just ended, a year ago, in 2021, the Fed said, every Fed member, there was not one Fed member that said interest rates today would be above 1%. Talk about a miss. It doesn't get any worse than that, all right? For 2023, this coming year, a year ago, there wasn't one guy that thought the Fed funds would be above 2%. Now everyone's at 5 or higher. So what's to say they're not wrong here? The Fed has lost credibility. And if the Fed were an NBA basketball team, every player would be benched, sent to the minors, or cut because they've done a terrible job. Now, what's interesting here is the market is picking up on this, all right? It's funny because someone said to me, why is the dollar down and gold rallying when, interest rates haven't moved? I'm like, well, you're not watching the forward Fed funds futures because the market is pricing 100 to 125 basis points of rate cuts in the first half of 2024. The market is more on top of this than the Fed, but that's almost always the way. It was certainly the way in the beginning of the inflation cycle. Now, there's a lot here too, but the thing to know is back-to-back declines in the US stock market have only happened 4 times since even 1929. The Great Depression was one of them. World War II, the 70s, of course, with the hostage and the oil crisis, and then tech bubble. Now, what's interesting here is 3 of the 4 times you back-to-back years, you declined in the third year, and every time the third year was the deepest decline. So you can imagine you have another down year this year, and next year's even worse. Now, this doesn't carry weight in terms of this is a tell for now, but it's a tell of kind of where I think things are going, because I think that the markets are unrealistic in terms of their assessment of whether you have a recession or not. The stock market here, the S&P has met its near-term downside targets, all right? This is why we could have a melt-up in the meantime. It's not like I'm sitting here bearish stocks. I'm not right now, all right? You could have a melt-up. I'm bullish on commodities to play the flip side of this inflation. I don't want to necessarily buy stocks per se, but you could have a melt-up situation. You hit the 50% retracement, you hit the 5-year moving average. It's a pretty well-defined pattern in the S&P 500. The problem is the longer-term pattern is nowhere near as bullish. The angle of ascent since 2008 is pretty obvious. It's ridiculous. It really is. When you talk about any kind of angles, any kind of geometry, it's kind of insane. I've been in the business since 1984. I've seen this entire chart play out. I mean, I remember when the S&P was first introduced a few years before I got into the business. If you ask me, this is kind of, you had the A wave of a bigger correction. The B wave will be the melt-up rally, suck everyone back in because the Fed's coming, there's gonna be no recession. Then the recession hits, the Fed really can't do anything about it or waits too long again, and then you get the C wave down. And you get this kind of thing where a 50% retracement here, you're talking about 2,500 or lower in the S&P 500. And that would be a target to be buyer some point, fourth quarter, first half of 2024, something like that. The AOA, I use this a lot, the angle of ascent. Look at the NASDAQ. I mean, you put the Gann, angle lines around this, and it's insane. 1999, 2000 wasn't anywhere even close to this, all right? You've hit the top end of the expanded range that included the entire bull market since 2009. Do we deserve to be above the top end of the last 15 years of bull market and really sometimes very solid economy? No way, all right? That also happens to be the 38% retracement of the move since 2008. You get below 10,740 in the NASDAQ, it's good night, Gracie. Talk about the Dow. Do you think we're gonna have a new bull market from here? I don't think so. I mean, you're still, in terms of the rate of change, you're still at one of the highest levels ever. In terms of the directional movement indicator, you're at one of the highest, the second highest level ever. And you're gonna tell me you're gonna start a new bull leg from here? I don't see it. I see a breakout, melt-up scenario that sucks everyone back in, and it's a massive bull trap. 5 bear markets in the Dow since we abandoned the gold standard. The average decline to the low, 42%. To get to that level now, you'd have to go to 20,000. That's the average. That's what usually happens. And that's kind of what I think we're coming to. All right, so we're holding an ace high royal flush. You cannot beat an ace high royal flush. You're probably not going to split the pot either. I don't think I've ever seen two ace-high royal flushes in the same hand. What does that mean? It means debt. Do you think the Fed can beat the ace-high royal flush that debt holds? Debt is higher everywhere. What are the cards? The ace of diamonds, the king of diamonds, the queen of diamonds, the jack of diamonds, the 10 of diamonds, in order of their importance. You see those things. We're going to go through each one of them. Do you believe derivative risk held by commercial banks is $630 trillion? That is a mind-numbing number. Mind-numbing. Let alone just, of course, it's half a quadrillion in terms of the interest rates, all right? But in terms of foreign exchange, this is where it gets a little dicey, all right? It's $100 trillion. $100 trillion. The Fed's balance sheet's 8. I mean, think of all the G3, the G7, they put all the central banks together. They're not coming up with $100 trillion. Not only that, but now a lot of foreign exchange trading has gone off book, if you will. Non-bank financial intermediaries. It's not, futures are picked up, actually volume 2, but a lot of this is not being done by the banks, by the normal FX, mechanism. It is being done kind of off book. As talk is, I've heard some estimates as high as 65 trillion in dollar-denominated derivative risk that is not accounted for. It's there, but it's not on anyone's books. In this case, Bloomberg pegged it out at around 30 trillion. It doesn't matter. Either number is like, an ELE, extinction level event. Fed's balance sheet peaked at 8.9. It's coming down, and it has one of the most rapid declines we've ever seen. Is QT, right? You're down almost 400 billion in terms of the last 12 months, a rolling 12-month figure, right? The deepest ever was, ended in 2019 at 483 billion. If you remember, global economy peaked in the fourth quarter of 2018. U.S. peaked in 2019. Markets were already on the ropes in 2019. The Fed was already loosening or preparing to loosen in 2019 when the pandemic hit in the beginning of 2020. So the pandemic didn't cause a recession, it just made it a lot worse. It was coming anyway. And it just shows you, again, without perpetual monetary tightening, let alone, or easing rather, if you have monetary tightening, QT, and interest rates to the level, now they're probably going to be above inflation in the not too distant future, it's just a real problem. You throw in the ECB, also liquidating, and you throw in the BOJ. You've never had all three G3 banks on the negative side of the asset balance sheet, bond market dynamic ever. And now you do. And you have more debt by all these countries than ever. The biggest buyer out, more debt than ever, not a good equation for the bond market. So this plays in with, we think there's going to be a higher low in yields. I think yields will come down, but they've already come down a lot. I mean, you look at the Canadian market, you're pricing in a lot when you look at the 10-year, 10-year yield. So there's really no skin to be had there. There's no vig to be had in the bond markets, even if you want to be long the bond markets. And I think, when the Fed takes their foot off the pedal and you start dealing with some of these debt issues, it's going to be a real problem for bond markets. In terms of the GDP, debt to GDP, used to be Japan, then it was Japan, Greece, and Italy. Then it was a few emerging market countries. Now it's 24 countries above 100% debt to GDP, including Canada, including the US, including France, including a lot of major economies. The US is at 137.2. That's Italian-like from 5 years ago. We know the studies, above 100 and increasing, debt crisis. So let's talk not only global inflation, global food crisis, global, you have Martin Armstrong talk about, sending 500,000 Russian troops into the Ukraine. Can you have any more volatility just in the environment, macro-wise? So what happens? Well, your paycheck is worth less the second you cash it. All right, your savings are gone. You got to pay the bills. The bills are going up for everything: shelter, utilities, parking, childcare, public transportation. If you're a commuter, you're getting slaughtered, right? So what do we have? We have a consumer that's having to borrow money to pay the bills, and borrowing at unprecedented rates that, again, having done this for 40 years, these are mind-blowing numbers to me. All right, you have 10 months in a row above 20 billion. I remember the first time the monthly number was above 20 billion, it was like, holy mackerel, it's like, like an economic seizure. This is a situation where you can kind of look back over the history. This is unprecedented level of borrowing, and it's out of necessity, all right? And you can see the year-over-year rate of change, or dollar change, nominally. You make this not 12 months, but 15 months, so you capture that entire period. You're talking about 425, almost $500 billion taken down by the consumer in debt in the last 15 months. Where's the next $1.5 trillion going to come from? Where's the next 15 months going to look like? Not only that, they're borrowing more money than ever at the highest cost ever. All right? The average interest rate on U.S. credit cards, 19.4. I was informed by a gentleman last night that in Canada it's already 21%. Look how much higher it is than anything you've ever seen. And in that case, same with auto loans. We already know we've seen delinquencies rise. Delinquencies, foreclosures, bankruptcies, they're all coming. They've all been held down like a beach ball under the surface of the water. You let go, forbearance is gone, the beach ball is going to explode up to the water, and that's what you're seeing now in terms of delinquencies. Foreclosures next, bankruptcies next. And then let's talk about the unfunded liabilities of governments, of state, local governments. The city of Chicago is a great example. All right, their underfunded pensions amount, $32 billion, has risen by 50% since 2015. There was actually a period where they paid some of it down, but that went by very quickly. All right, so what do? They raise property taxes. So not only do you have inflation, not only do you have all these things going on, you got to pay more for property taxes because the city mismanaged their finances. Man, doesn't that sound like 2007? So is it mission impossible to keep the value of your paper money from being debased by governments, by central banks? It is, but this is what you're looking at, mission impossible. You're hanging on by fingernails, man, and it's like, holy mackerel, can we do this? And people are, it's funny how this kind of paralyzes people. They're afraid to do anything when they should be absolutely doing something. Now, when you talk about the dollar, here's one of the big risks. The dollar share of official foreign exchange obviously down a lot. Russia now holds more renminbi and gold than dollars, okay? And that's very strategic, and we could talk about that off-site. But what's interesting about it is most of the usage of dollar is for trading, all right? As a percentage of world trade, it's shrunk and it's small. This is where the big risk to the dollar is. Here's where the black swan risk is, and it's China and Russia and OPEC combined, all right? When you look at world trade, China imports and exports more than $300 billion of stuff every single month. That is 50% more than the next competitor, which is the US, roughly, a little bit less than 50%. All right, so it is China's power now. U.S. goes and seizes Russian central bank assets and say we're going to play the financial weapons war. We don't have the nukes. China and Russia do. And until now, it's been mutually assured destruction. No one's going to do anything because China would blow up too. Xi is a different animal. He's Mao Zedong reindoctrinated. All right, he's a manifest destiny guy. If you know his history, his background, his childhood, his whole 9 yards, his whole story. All right, the day that China says we'll only accept renminbi for our exports and we'll only pay renminbi for our imports, the world changes. And that day's coming. Just a question of when and how are we prepared for it. All right, one way is gold. Gold is in reach of a new all-time high, yet open interest is low. The on-balance volume is low. It's like people are afraid of gold now, too. I mean, I've had a lot of discussions already in the last 36 hours. Like, what do you think about gold? Kind of disappointing. It's like, it's almost at a record high in a period the dollar was just up 20%. That's pretty damn good, let alone the fact that gold is making new highs almost every other currency on the face of the planet. You have a multi-decade, very solid technical picture underpinning gold here. It can really take off here, I think. The Fed's in the way because the Fed doesn't want this to happen. So it's a question of push and pull with the Fed. It's kind of a tug of war with the markets and the Fed right now. But gold relative to the S&P, it's maintaining its breakout. It's above the 52-week moving average. It's a higher low. It's now appreciating 8% over the last 12 months relative to the S&P 500. This trend will intensify, break out, and accelerate. Gold in Canadian dollars, well, it's almost a new high. Think about this. 2000, it was at 400. Now it's almost 2,600. All right, that's a 600% gain in gold. But more importantly, you flip this, you invert this. The purchasing power of the Canadian dollar has been devalued by 85% since 2000. You measure it against a car, you measure it against an apartment, you measure it against a gallon of gasoline. You see it everywhere. And people don't get this, and it's only going to get worse in the future. Now, what can you do? There's a lot of words on this. You want the PDF, we'll give you the PDF. The bottom line on this chart is you have to take action, and you need to own more than gold. To me, the futures markets are just, I've been a futures guy for 40 years. I've been a proponent of the futures market for a long time. Futures markets gets a bad rep because nobody understands the math in the futures markets. It's no more risky than the stock market. It just isn't. Most people are undercapitalized. You can't trade futures for 50 grand. Because a $10 move in gold, if you own 10 contracts, will wipe you out and you owe the broker 50 grand. All right? People don't understand that, but that prohibits them from using these amazing tools where I can be long or short bonds. I can be long or short any stock market in the world. I can be long or short any commodity. All right? Since I did this speech 3 years ago, our managed accounts up 66% after fees, destroying any other asset out there in terms of a broad asset. All right? In that case, we do a boot camp because if you want to do this yourself, there's a lot to learn, and I'm happy to teach you. So we run boot camps for futures trading. It covers all of these various things. Here's part of the math that I want to get to you real quick before I wrap it up here about the underlying contract values. Again, people look at the margin. You put up $5 grand to own a gold contract, all right? $5 grand gets wiped out with a small move in percentage-wise in gold now because the contract's so high. At $2,000 an ounce, it's a $200,000 contract. Take the S&P 500, all right? It wasn't much more than 10 years ago. One contract, the S&P 500, was worth $200,000. Today, it's worth $2 million. So a 5% move today is a lot more money than a 5% move was previously. So you have to know the math. And it's not only that, it's also the risk around the math. I'm a very low-risk guy. 0.4% is my initial trade risk. And it's low because I tend to be early, and I want to give myself a couple of opportunities to maybe get stopped out before it's ready. Get stopped out one more time, and then it explodes. Our recovery time is very fast because of this. But I measure risk in a variety of ways. This is the actual spreadsheet that I get produced for me. Each client has their own spreadsheet. Each client has their own money in their own name. We don't touch it. It's theirs. They get reports every day. You know exactly what we're doing every single day. Full transparency, the only way we can be credible. And in this case, we look at risk to stop, we look at the sector risk, the entire portfolio, the value of risk, the leverage. I mean, I'm a math and science geek at heart. You might not look like one, but this is what we do. And it's all math-based. It's $1 million minimum, but it's $1 million minimum because if I want 0.4% to be my minimum risk, that's $4,000. There are times when the DAX, Palladium, some of these markets, the risk to my stop, which is defined by where I'll be wrong, not by the amount of money I want to make or lose. Position size is back engineered, but it's, to the degree that there are some markets where I want to take a position and the risk is $12,000. Even with $1 million, I'm not taking $12,000 of risk in one trade because, the math just doesn't work. And I've been doing this for a long time. I've learned from some of the best in the business. So from that context, you have to do a lot of, if you want to do this yourself, you have to know the math. And we're happy to teach you the math. We don't just take money from everybody. But the bottom line here is the game of speculation, okay, not only game for the stupid, for the mentally lazy, but it's not for the person of inferior emotional balance. What does this mean? It means you have to know yourself. All right, trading is ultimately an exploration and a journey into your innards, into yourself, into your trauma, into your triggers, into how you cope with all these things. All right, all the psychology comes flowing out. Van Tharp is one of the greatest trading coaches in history. All right, I've studied under him. Some of the people I've worked for studied under him. He came up with the belief that trading success is only 10% your methodology. It's 20% your risk management. The other 70% is psychology. It's your psychology. And every trader says that. The other thing, of course, is cut your losses, let your profits run. But that is based on psychology. A lot of times I've seen it. I've seen great traders blow up on one trade because their ego gets in the way. This is a thing where you can't have an ego in this business because you have to be willing to admit you're wrong a lot because you're wrong almost as much as you are right. And that's okay because if you have winners that are 2.5 to 3 times your losers, you're going to make a ton of money, right? But it is a psychological war with yourself, all right? And I've seen people blow up on a single trade, and you can't let that happen. So I would like to say one more thing before we close out. Me personally, I've been working with Michael Campbell for 20 years. There's not many people that I see that have the tenacity and the passion for what we do and for the ability to get out there and to put himself out there and help people. I want to give Michael Campbell a standing ovation. And I personally want to give you a standing ovation for putting up with me for 45 minutes.